There was a time when flexibility in business was considered a luxury. If a company had extra capacity, excess cash, diversified suppliers, or optional expansion plans, it often meant lower short-term efficiency, and in highly competitive markets, efficiency was everything. But today, that thinking has changed. Businesses are treating flexibility like insurance, something you pay for upfront to protect yourself from much bigger losses later. The shift didn't happen in theory, it happened through experience. Over the past several years, companies have faced rapid demand swings, supply chain breakdowns, labor shortages, rising interest rates, geopolitical disruptions, and sudden technological change. Each wave exposed a common weakness. Organizations that were optimized for perfect conditions struggled when reality became unpredictable. In response, flexibility is no longer seen as inefficiency, it is seen as protection. Start with capital allocation. During years of cheap money, companies were comfortable committing large amounts of capital to long-term projects. If assumptions changed, refinancing was often an option. But in a higher-rate environment, borrowing is more expensive and investors are less patient. Now, instead of making massive, irreversible bets, businesses are structuring investments in phases. They build factories in modules. They test markets regionally before going national. They use pilot programs before full rollouts. This approach may slightly delay peak returns, but it provides something more valuable: the ability to adjust. And that adjustment capability acts like insurance against uncertain demand or cost spikes. Cash reserves are another example. In the past, holding excess cash was sometimes criticized as underutilized capital. Shareholders often preferred aggressive reinvestment or buybacks. But after repeated shocks, liquidity has taken on new importance. Companies with strong cash positions can absorb revenue dips, manage supply disruptions, and seize opportunities during downturns. Those without it may be forced into defensive decisions at the worst possible time. Liquidity, once seen as idle capital, is now viewed as a shock absorber. Supply chains illustrate this transformation clearly. For years, lean, just-in-time systems were considered the smartest way to operate. They minimized inventory costs and improved margins. But when global logistics froze and component shortages hit, companies discovered that lean systems offered little room for error. Now, many firms maintain diversified suppliers across regions. They carry strategic inventory buffers for critical inputs. Some are reshoring or nearshoring production to reduce geopolitical exposure. These changes often increase costs slightly, but leaders increasingly see those costs as insurance premiums, small, predictable expenses that protect against massive operational shutdowns. Workforce strategy has also shifted. During growth periods, companies once hired aggressively to capture opportunity. When downturns followed, layoffs were painful and expensive. Today, businesses focus more on scalable workforce models. They invest in automation where it improves flexibility. They cross-train employees to handle multiple roles. They rely on contract structures that allow capacity to expand or contract more smoothly. Flexibility in labor reduces the risk of drastic restructuring when demand shifts. Technology investment follows the same logic. Companies are investing heavily in AI and data systems not just for growth, but for adaptability. Better forecasting tools help anticipate demand swings. Automation allows production levels to adjust more quickly. Cloud infrastructure provides scalability without heavy fixed costs. Instead of building rigid, highly customized systems, businesses prefer modular platforms that can evolve as needs change. Even real estate decisions reflect this insurance mindset. Flexible office arrangements, shorter lease terms, and hybrid models reduce long-term commitments. Companies are less willing to lock themselves into decade-long obligations in uncertain environments. On the financial side, debt management has become more conservative. Firms are cautious about taking on leverage that could become burdensome if revenue slows. Refinancing strategies are timed carefully. Interest rate exposure is managed more actively. These decisions reflect an understanding that volatility is not temporary, it is structural. Investor behavior reinforces this shift. Markets increasingly reward predictability and disciplined risk management. Companies that demonstrate stable margins, consistent cash flow, and cautious guidance often receive valuation premiums compared to firms with volatile results. In this environment, flexibility is not just operational, it is reputational. It signals competence. Another key factor driving this mindset is demand unpredictability. Consumer behavior can shift rapidly. Enterprise budgets can freeze or accelerate within quarters. Relying on a single revenue stream or customer base creates vulnerability. As a result, companies diversify revenue models. Subscription services, recurring contracts, and diversified product portfolios reduce exposure to any single demand shock. Revenue diversification functions as insurance against sudden downturns in one segment. Geopolitical risk has further strengthened the case for flexibility. Trade restrictions, regulatory changes, and shifting alliances can disrupt operations unexpectedly. Businesses now incorporate political scenario analysis into strategic planning. Expansion plans often include contingency options. Contracts include renegotiation clauses. Market entry strategies are structured to allow exit if conditions deteriorate. In previous eras, maximizing scale quickly was often seen as the smartest move. Today, preserving optionality may be smarter. Importantly, treating flexibility like insurance does not mean avoiding growth or ambition. It means designing growth in a way that can survive turbulence. The companies thriving in this environment are not necessarily the most aggressive. They are the most adaptable. They build cost structures that can flex. They maintain liquidity. They diversify exposure. They use technology to monitor conditions in real time. Flexibility provides time, and in uncertain environments, time is one of the most valuable assets a company can have. Time to adjust pricing, time to secure alternative suppliers, time to pivot strategy, time to ride out short-term volatility. Without flexibility, small disruptions can escalate into existential threats. With flexibility, even large shocks can be managed. Corporate culture has evolved alongside these structural changes. Leaders encourage faster decision-making cycles. Planning horizons are shorter and regularly updated. Scenario analysis is routine. Risk discussions focus on what could break, not just what could succeed. This mindset reflects a broader realization: the cost of being unprepared is far greater than the cost of carrying buffers. Insurance, by definition, feels unnecessary until it is needed. The same is true of flexibility. When markets are stable, redundancy can seem wasteful. But when disruption hits, that redundancy becomes invaluable. Businesses have learned this lesson repeatedly over the past decade, and instead of assuming the next few years will be calm, they are preparing for continued volatility. Flexibility is no longer optional. It is strategic protection, it is operational resilience, it is financial defense. In today's market, treating flexibility like insurance is not conservative thinking, it is forward-looking leadership. Because in an environment where disruption is expected, the companies that survive, and often win, are the ones prepared for it before it arrives.